Hello people, welcome back to part 2 of short portfolio video. With our part 1 video on short portfolio, you would have understood the logic behind creating a short portfolio and why we expect for this down move to come very soon. In last video, we shared the scripts that we have shortlisted for our short positions. Now, in this video, we will learn the 2 approaches to take benefit from our short portfolio. And at the end of this video, we will share the bonus advice to benefit from the fall in markets. Also, as mentioned earlier, I prefer approach 2. Keep that in mind, but it needs more capital and active management. So let's start with approach 1. Here you can take a pause and analyze the portfolio that we are creating using ITM puts. Although I won't prefer it for myself, but this could be helpful for someone with less capital and appropriate risk appetite, or those who want to trade few of these scripts. As mentioned earlier, here we have created a portfolio using October series puts. But if by the end of September series, the down move does not come, you have to shift it to November puts. And remember, keep these puts ITM always. That means in case the spot prices crosses the strike prices of our puts, we will shift the put to further ITM. That is, we'll sell this put and buy higher strike price. This will reduce the impact of time decay. Time decay is important. Yes, the risk is high as you could lose the premiums that you are paying here. But if you properly manage your capital and keep a check on your position sizing, at the same time prepare yourself with a setup that you may have to shift these positions for next 2 to 3 months, you should be able to make a very good profit with this portfolio. On the screen, you can see that if the mentioned scripts come close to 50 DMA, it could make your portfolio grow by 3 times. And if it comes closer to 200 DMA, portfolio could be 6 times. But as mentioned earlier, many of these stocks have the potential to multiply your portfolio by 10 to 15 times. And isn't that incredible? So if we are lucky, we might see multi-bagger returns from the portfolio. Fingers crossed. Also, due to illiquidity, here prices of few options were not present. So I have used guesstimation for the same. You need to wait and put limit orders to enter the same. But remember, illiquidity could be a concern in case you want to exit in mid. I would advise to avoid illiquid options. So now you can create similar portfolio for yourself, or can take this as a guide and create something on your own using any of these scripts where you have high conviction. Of course, in markets, no one can time markets to perfection. But we are logically taking these trades and are keeping a check on our risk and capital. Here, I would like to reiterate that take a trade based on your risk appetite and analysis. I'm mentioning this again and again, and I will also do that in future, since it is all your money. Now, let's begin with approach 2. In approach 2, what I am implementing is the combination of bear call spreads and OTM puts to create a short portfolio. It could give me much higher returns, but the capital requirement is more. But here the probability and impact of losses is much lesser. Here my approach is very simple. Firstly, I'm taking some safety margin, that is, I'm writing OTM calls and hedging them with FAR OTM calls. The same what we do for our intraday or positional trading. With this, the best part is that my risk per trade is fixed, and I also know the maximum possible profit. Secondly, I'm buying OTM puts for next month series. Here some of the money to buy these OTM puts is coming from the expected profits of the call writing trades. And as these are this is an extraordinary time, these can give us high speculative returns that markets want to offer. I would like to answer two doubts that can come across anyone's mind. First, what if these scripts continue to rise? Will the impact of loss will be higher? My answer to this is yes. If stocks rises further up, I will lose on both the trades. But here many things are in my favor. Let's understand this with an example. Look at current level of Nifty. It is at 17,585. What I have done is that I'm writing 17,600 calls, which is 15 points away from current levels. Also, net premium that I am receiving from call writing trade is 101, which means till the time markets don't cross 17,701, I won't incur loss. Also, I have 13 days to manage this trade. If markets start falling, they keep on falling, then like a trailing stop loss, I will move this trade lower. That means if markets start moving in my direction, I can make more profits from call writing trades. If the correction happens till 50 DMA, that is 16,282 level, I could possibly move this trade multiple times and could easily target close to 250 to 300 points move from just the call writing. At the same time, the OTM put of Nifty 16,500 bought for 57 rupees could be 2 times, and to manage that I have roughly 43 days. Second doubt that can cross your mind is the inclusion of high beta stocks in the portfolio. Yes, the reason to buy this is simple. Just have a look at Adani Entertainment. It is a high beta trade. Possibility of loss is there, but currently it's trading close to 6 times of its 52 weeks low. It has already shown signs of reversal as it's already down by 16% from its 52 weeks high. This stock has the potential to fall by 7 to 10% in a single day with the market. And if the fall comes in overall market, I won't be surprised to see its 1400 put of 57.5 rupees to trade at 350 to 400 levels easily, give or take. That's the reason I have included few high beta trades in the portfolio. Now you can take this Excel as a guide and create your own portfolio. In this approach too, I have mentioned profits instead of times, as we are trading using margins as well. In this portfolio, if Scrips come closer to first target, we would make close to 60% returns without any adjustments. And if come close to second target, we will make close to 200%. Target 3 will be bonus. Bingo. Here I want to highlight that even if the market sees a 10% fall, and if I am still actively managing my portfolio, I won't be surprised to see many multifold return on my portfolio. Now, here comes the bonus part that I wanted to share with you guys. Actually, on my Telegram channel, I have already mentioned that it's always possible that this fall does not come in next 2-3 months. Then how to recover your losses? Like, how does someone recover his or her losses? Answer is very simple. Just put across 20% of your capital in December month ITM Nifty puts, as this move cannot be prolonged forever. What I have personally done is that I have entered in Nifty 18,000 puts, which are I entered close to 580 levels, and I expect these to be more than 3-4 times easily with the fall. That means this will alone take care of my losses if the down move does not come by October or November. But here also, remember to keep this put ITM always. I will shift it further ITM if Nifty comes close to 18,000 and shift same quantity to capture profits if fall comes first. Remember one thing, it may take 3 months for markets to go up, but it takes less than 1 month to fall. Anyways, to turn this put 3 times, we just need Nifty to trade at 16,000 levels, which is just 9% shy away from current levels. I know there could be many questions in this video, as this is my view and way of trading. It will vary from trader to trader. You can ask as many questions you want in the comment column. I will be happy to answer the same. Hope this video helps many of you to benefit from such high speculative market situation and grow your capital. My motive of making this video was very simple. You guys can learn how to identify and analyze the market, especially in speculative time, and you could benefit from such moves in future as well. With this, I would like to repeat one marketing line. Please like, share and subscribe. Also follow our trades through our Telegram channel. Best wishes and happy learning as always.